Karl Schamotta. He's chief market strategist at Corpay. Karl, great to see you. And I guess let's start with how closely you're watching the tone in the housing market when it comes to the outlook for Canada's economy this year.
Yeah, so, we're clearly at risk of a bit of a melt up here. The fact that global rate expectations fell so much back in November has really sort of bolstered consumer confidence. It has lifted the appetite for investing in real estate, and that is leading to a situation in which we actually might see a rebound in the housing market in the early spring. Certainly not something that would blow the doors off, but far better than many had expected, including myself last year, without doubt.
and so sort of listening to the comments from the Canadian bank CEOs, I assume if people are ready to jump into the housing market, they have enough savings that they can address not only higher prices, but the fact that, if you're getting a mortgage today, it's going to be more costly than it was a few years ago. Or if you're somebody that's renewing a mortgage, obviously your costs are higher. Or as we mentioned as well, you got to consider the taxes on properties as well going up. I mean, this is sounding pretty costly.
That is, it's kind of interesting too when you think about what the bank CEOs are really telling you, right? They're telling you that their loan books are likely to remain relatively stable. Like they're not looking at, having to put aside huge cost provisions for a wave of defaults in mortgages. That does not mean that the economy is going to emerge unscathed, right? They're clearly pointing to a long-term drag on Canadian consumption, right? So households are going to get hit by increasing mortgage costs this year, but much more next year and the year after, at the same time that they're getting hit by these, higher property costs or higher property taxes and other increases in the cost of living. So, at the end of the day, the big issue for the Canadian economy is, do we underperform as consumers pull back and, sort of tread more cautiously in the years ahead? I would suspect so. And that is what is sort of tying into what we see in currency markets and in interest rate markets right now.
So for the Bank of Canada itself, and they've said the fight against inflation is not done. What do they do? What do they do if you're getting these indications that consumer spending is slowing down? What happens with interest rates this year?
Right. So I think in the near term, they have to push back a little bit. They know that if they encourage borrowers to go out and sort of jump back into that mortgage market and sort of spend with, no sort of recognition of what might happen in the future, they know that that could cause an inflationary overheat. So I wouldn't be surprised if we see in the next couple of months a little bit of hawkishness in rhetoric. Like, we could see policymakers sort of trying to convince Canadians to be more prudent. However, at the same time, of course, they see the writing on the wall. They see that, the economy is slowing, and they are likely to closely match the Federal Reserve in providing accommodation through the latter half of the year. So, rate cuts could begin within 3 to 6 months, and that is likely to relieve some of the pressure on households.
And I'll just reiterate what you're saying, which is that delicate balance for the Bank of Canada. If they start cutting interest rates because there are signs that maybe that is the right thing to do, if people keep jumping into the housing market every time there's an indication of that, that complicates the story. We will watch it. You mentioned the United States and the Fed. We are anticipating some inflation data. Well, we're getting some inflation data tomorrow, but we're going to be watching the market reaction to that. How are you viewing the situation stateside right now?
Yeah, so inflation is clearly subsiding in the U.S. and globally. We are expecting to see resilient headline inflation just based on sort of comparables and year-over-year effects, but the core inflation print should continue to subside. And so that does help to rationalize and justify what we're seeing in markets. Markets are expecting, a rapid and accelerating pace of rate cuts from the Federal Reserve. However, what we are sort of looking at in the interim before that inflation print is a speech from John Williams this afternoon. So that's the New York Fed's John Williams. When he spoke back in December, he did appear to be pushing back against that sort of unwarranted, premature easing in financial conditions that has occurred as inflation prints have come down. So what we may see is sort of a 1-2 punch here in the sense that he may try to steer markets in a slightly more hawkish direction, try to convince markets that the 3 rate cuts that are currently priced into the Federal Open Market Committee's curve are more likely to happen than what the markets currently think. The markets are currently priced for 5 cuts over the course of 2024. So we could see a bit of a convergence between the two. And so I would not ignore that speech. I think it comes at about 3:20 this afternoon. I think it could be relatively meaningful in terms of setting the stage ahead of tomorrow's inflation print.
Okay, we'll watch that closely. It'd be cool if the Fed's John Williams took the music from the composer John Williams, like a Star Wars theme, and used that as the backdrop to just spice up some of this monetary policy speak. Since you watch the currency market, and the market has obviously been the larger theme of the last few months, because of this idea of interest rates coming down in the U.S., has weakened the U.S. currency. We saw the Canadian dollar, I want to say, in the 72-cent range coming into November. We got above 75 cents. We've pulled back a little bit. How should we think about the Canadian dollar in 2024?
Yeah, so it is kind of funny because, if we were to think about this through a John Williams lens, we may have seen the crescendo happening pretty early. The fact is, you and I spoke about this back in October. It was expected to happen. We did expect that, that the Fed would start to turn more dovish, that the Canadian dollar would outperform a bit on the back of that. And now we're beginning to sort of flatline. Eventually, I would suspect that we pull back a bit. So right now, interest rate expectations on both sides of the border are relatively consistent with one another. They've both moved in synchrony with each other for almost 3 months. At some point here, we should see signs of weakness in the Canadian economy growing stronger than they are in the U.S. And so that should, put renewed downside pressure on the Canadian dollar. So those gains today, I wouldn't expect them to last all that long. And I would certainly be, I want to flag to almost everybody right now that volatility expectations in the markets across equities, FX, commodities, they're way too low. They've got to move higher from where they are today.
Karl, great.